Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. One of the challenging things in today's market is finding companies that have great businesses that are still growing, generating cash, and trade at attractive valuations. One that I think fits that is MGM Resorts. Now, casino investing isn't for everybody, but if you are interested in this industry, I think there's a lot of tailwinds. And this is just a money-making machine. So I want to go through what the trends are in the company's biggest markets and what to look for long-term. My name is Travis William. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, I have a deep dive on MGM Resorts. I have a link to that in the show notes, so check that out. Now, I want to start by laying the groundwork with the company's results in its three main segments. MGM splits the business into Las Vegas operations, regional casinos in the US, and then Macau properties. Those are the three main segments. There's a couple other things that I'll talk about a little bit as well, but those are the real things that are driving results. You can see that Las Vegas continues to do extremely well. Revenue was essentially flat. There's only a $10 million difference here between revenues in the second quarter of 22 and 2023. Some of the positive trends are hotel occupancy increasing a couple of percentage points, average daily rates up 4%, and revenue per average room up 8%. Adjusted property EBITDA, which is earnings before interest, taxes, depreciation, amortization, and rent, was down slightly. That's because the company is starting to ramp up some of its operations, some of the costs that go along with that were cut back during the pandemic. So this has been something that we've seen across the industry, is that margins are coming down a little bit, but still extremely high. Pre-pandemic, if you saw a margin over 30%, that was really good for the casino industry. So things are going really well in Las Vegas. This run rate is between $3 and $4 billion, depending on where you think the normalized level of adjusted property EBITDA is. So that's kind of something to keep in mind. $3 to $4 billion coming from Las Vegas alone. The regional operations are a bunch of casinos scattered across the country. They have a casino in Massachusetts, one in the DC area, one in Detroit, and a number of others. You can see that revenue was down slightly. EBITDA is also down slightly, just like we saw in Las Vegas. Margins still pretty solid at 31%. I would look at really both of these segments as just cash flow machines. They're not building a lot of new resorts, either on a regional basis or in Las Vegas. So you just want these to be continually spitting off cash. And here we're seeing about a run rate of $1.2 billion per year in adjusted property EBITDA. So strong results, a lot of cash flow coming from there. Macau is, or as MGM calls it, MGM China, that's what their subsidiary is called. They own 56% of the subsidiary. And the recovery story is really starting to take hold in China. Remember that Macau was actually hit with the pandemic before we even saw that in the US, shut down in February 2020, and didn't really recover until earlier this year. So we're starting to see revenue come back really quickly. These numbers are actually in comparison to Q 2019. So you can see that revenue and adjusted property EBITDA are both better than we saw before the pandemic. Margins also up really significantly. There's still a lot of upside in Macau. I think revenue could grow between 20 and 50% in Macau as we get back to a more normalized level. But here again, really solid cash flow, likely on pace for over $1 billion in adjusted property EBITDA just from the company's two properties there. This chart gives you a little bit of an idea of how quickly Macau is recovering. This is the percentage in gross gaming revenue as a percentage of 2019. Q4 2022 was at 4 to 62%. That's why I said there's still upside, but MGM China has been taking market share. They're actually above where they were before the pandemic hit, as I showed earlier. So taking market share, and Macau is growing. So great trends in Macau. The other business to highlight is the digital business. This is not something I put a lot of value on when looking at MGM Resorts because it's not generating cash at this point. And it's not clear exactly what the business is going to be, whether it's going to be profitable or not, but it's upside. If it does do well, MGM will have further upside for investors. So this is going to do almost $2 billion in revenue this year. This is BetMGM. This is the US operations. The company owns 50% of this. There's also an international business that they acquired. That's really just getting started, but you can see that this could potentially be a big business. Contribution break even is what they're expecting in 2023. So not a lot of impact on the income statement, but a business that could provide value in the future. The other thing worth covering is the company's cash rent payment. Remember, I talked about EBITDA earlier, earnings before interest, taxes, depreciation, and rent. Well, this is what the rent number is, about $1,700 in rent. So we talked about there being somewhere between $4 and $5 billion worth of EBITDA in the US from regional casinos and from Las Vegas. So that leaves somewhere in the neighborhood of $2.5 to $3 billion in earnings before interest, taxes, and depreciation after you take out that rent. And this is where things get really interesting because MGM Resorts, I think, is relatively undervalued by the market. And this puts some numbers behind it. Remember, this is from the company, but this is using a share price of $50 per share. That means the consolidated market value of equity is about $17.5 billion. If you take out their 56% stake in MGM China and the 50% stake in BetMGM, which they say is worth about $5.5 billion, and then add back net debt for MGM Resorts, you get an implied enterprise value of $11.8 billion. That is only 5 times adjusted EBITDA. So that includes rent. And the other impressive thing you see here, look at this, not a high debt company anymore. This has been something that a lot of the casino companies have been high debt for a very long time, but that's not the case for MGM Resorts. So arguably, this is a pretty good value stock. And we aren't even considering its potentially biggest growth asset. And that is this casino here. This is the casino that the company is going to build in Osaka, Japan. They're going to own about 40% of this property. But it's very possible, given the wealth in Japan and the way that that market likes gambling, that this casino could be the most profitable property in the world. It's going to cost about $10 billion to build. That will cost between $2 to $3 billion probably for MGM Resorts from a cash outlay standpoint. But the payback could be 1 or 2 years. I mean, it's very possible that it's that profitable. Marina Bay Sands is really the only other property that really resembles this. And that is probably the most profitable resort property in the world today. So this could overtake Marina Bay Sands. Really big potential opportunity, but isn't going to open until at least 2029, probably more like 2030. So the market really doesn't seem to be putting much value on this at all. But I think this is something investors should keep in mind. The other thing to look at is shares outstanding. I'm going to show the graph of shares outstanding because I think this is fascinating. Over the last 5 years, MGM has bought back nearly 200 million shares of stock. 540 million shares outstanding 5 years ago. Today, 351 million shares outstanding. So if that pace continues, remember, this is a relatively low enterprise value to EBITDA multiple. If the company keeps buying back stock, we could see a lot of value added just from those buybacks in shares. The great thing for MGM is I think the company is riding a number of tailwinds. One, people are just spending more on going out and doing things. But two, I think this is the big thing is as companies and people get spread around the world and need places to go meet, build culture, do things together, there's a few obvious destinations for that. And Las Vegas is one, Macau is another, and potentially Japan will be another in the future. I think that's going to be a really valuable place to be. And we've just seen this steady growth, particularly in Las Vegas, in the number of people going there and the amount of money they're spending, not only on the casino floor, but the amount of money they're spending on hotels, on restaurants, on entertainment, things like that. That's really what's going to drive MGM's growth. And remember, there's not a lot of places for the company to invest billions of dollars to build new resorts and casinos. So they're just going to be cash flowing the ones that they have. I think that puts the company in a phenomenal position. It may not be the growth stock that it was for a period of time, but if you're a value investor and you like a company that's churning out a lot of cash flow, MGM is a great one to look at right now. What do you think about this stock? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. And like I said, check out that deep dive I did on asymmetric investing on MGM Resorts. There's a link below. Thanks for watching, everybody. See you here next time.